The global economy is slowing, but it's still growing. Alongside policy support and the desire to buy equities, we think the market will trade much higher rather than lower by year end. We're optimistic on the outlook for equity markets. We think investors should steer into risks rather than run from them. We think that the equity market will be higher by year end rather than lower, and that in fact there's too much pessimism around the risks that are actually underlying the equity market at the current juncture. We're positive for 4 reasons. First, news flow doesn't have to be good, it just has to be better than expected. And when recession is the baseline, we think over the next 3, 6, 9 months, news flow will be better than expected. Secondly, we think policymakers will begin to ease rates in the second half of the year, not proactively, but reactively, because they don't quite know how much policy easing is required. Third, we think that valuations are not a great concern for further upside in equity markets. When growth is above trend and when rates are being cut, equity valuations generally are not a constraint to further upside in equity markets. And last, Australia is very well insulated from global trade concerns. It has a central bank now who is on an easing path and where inflation is not a concern, and which has outlined where the neutral rate is, and that policy remains still quite restrictive, which gives them a runway to begin to ease further into the second half of the year. One of the big concerns for equity investors after a 15 to 20% rally in global equity markets, including Australia, is that valuations are now at very elevated levels. We don't think that they're a constraint to further upside for a number of reasons. First, valuations tend to be better correlated with long data returns rather than short data returns. If you buy the equity market on 20 times, your long dated future return is likely to be lower than if you buy it at 10 times, but it does not give you a strong signal for how the market will trade on a very near-term basis. Secondly, when we are going into a slowdown, as long as earnings growth is above trend and policy rates are falling, which is where we think these 2 conditions will sit as we go into the second half of the year, then it's very unlikely that valuations will compress en masse. Thirdly, when we look at valuations versus earnings, valuation bubbles tend to be pricked by an interest rate shock, and earnings bubbles tend to be pricked by a growth shock. We don't think that we're in an environment where interest rates are likely to prick valuations on a broad scale. Lastly, when we think about what generally will derate an individual stock, it's earnings and earnings risk. And as we go into the back part of the year, as long as we're comfortable with specific stocks around the earnings side, then we don't think we have to be particularly uncomfortable with where valuations sit. Broadly speaking, we understand that valuations are a constraint for how people are thinking about adding money into the equity market. But as long as the fundamentals are still solid, and in fact, things are coming out better than expected, then we don't believe that there'll be a constraint for equities to trade higher into year end. At present, the risk du jour is rising US long bond yields due to unsustainable fiscal and debt paths. We don't think that they are going to be a big constraint for equity markets in the near term. We understand that the US is on an unsustainable path in terms of its fiscal spend and debt growth. But we think that these are structural shifts that will gradually mean that bond yields don't come down a lot, or they gradually move higher. We do not believe that they will detach from economic fundamentals. So if growth in the second half of the year begins to slow down, we'd be very surprised if long bond yields continue to rise. On that basis, unlike the consensus who has now shifted to rising bond yields as a big risk for equity markets and risk assets, we're taking a more sanguine view on this, and we actually think that they might be a constraint to runaway markets, but we don't think that they'll be an issue for equity markets in the second half of the year. In summarising, we understand after a 15 to 20% rally that there are a lot of concerns. Growth is slowing, valuations are high, interest rates are also high. But from an equity perspective, these are not constraints for the market to move higher. Ultimately, we think earnings growth here in Australia will remain reasonably solid. We think the RBA is set to cut rates further, and we think the cult of wanting to invest in risk assets has not been broken despite uncertainty and volatility that has been driven by global factors. As equity investors, we think you should steer into risks rather than run from them, and we do think that equity markets will trade higher by year end.